There are a lot of reports right now of the possibility of gold becoming money again. You must have heard that central banks around the world today hold more gold than they hold US Treasuries, and this is the first time in 40 years that that's the case. So for 40 years, central banks are holding more treasuries and now they hold more gold. So there's a shift away from treasuries towards gold. There are a lot of reports for many years now of the BRICS nations, so Brazil, Russia, India, China, South Africa, but also other countries alongside BRICS Plus. BRICS nations coming up with a gold-backed currency for trade. The price of gold, of course, is going through the roof, which is getting a lot of people excited, which is making people speculate about the possibility of gold as money again after all these years, after a huge gap where gold has not been money. Gold has been an asset, gold has been an investment, but it has not been used as a direct form of money. To answer this question, and it's not going to be simple, to answer this question, you're going to have to go back in history to first understand why money came into existence, why gold became money, and then why paper money or fiat replaced gold as money. Only then we'll be able to understand the challenges that gold faced, the roles that it fulfilled, the challenges it faced, and if there is a possibility of it becoming money again. Okay, so let's go back thousands of years where humans are still living in small settlements. They are trading directly with one another in a system that is called barter. So let's say I am a fisherman, I take fish out of the river or pond. You are a farmer, you're growing, let's say, some vegetable, and we just exchange directly. So I give you what I produce, you give me what you produce, and that's how the economy works. Now, as human economies and human societies became more complex, as they started producing more and more goods, more and more services, as there were more and more people living within these communities, barter was not always working, because for barter you need a double coincidence of wants. I need to have exactly what you need to have exactly what I need, and then we can exchange. So when this condition was not fulfilled, and this was happening more and more often, people felt the need for having something like money, having a medium of exchange that everyone in a society would be willing to accept in exchange for their goods or services. So to solve the double coincidence of want, we needed a medium of exchange, and that's how money came into existence. To start off with, money was things that people were already producing. So every, you can say, community or every society narrowed down on some form of money, which was typically a commodity, which was either some food grain or some form of cattle like cows or sheep or goat or whatever was prevalent there. And in a way, people were already using this to start to store their value as well. So when you're a farmer, and this is the second use case for money, when you're a farmer and you produce grains, let's say, or you produce vegetables, that's a better example. Vegetables tend to go bad in a few days. So even if you're an expert in producing vegetables, when you produce a surplus, you want to sell it, you don't want to consume all of it. And when you sell it, in exchange for it, you would want something that can last longer. So humans like to plan for the future. So something that lasts longer than vegetables is food grains, and something that lasts longer than food grains are cattle, like cows and sheep and goat, and something that lasts longer than cattle are precious stones and gems and seashells if you're living by the coast. So slowly humans moved from commodity money to more physical forms of money, moving towards things that were scarce or even more scarce. And money was always scarce. Rice, food, this was scarce. Cattle was scarce. None of this could be printed, none of this could be created spontaneously. But we'll get to scarcity later. The third function that money serves is that of a unit of account. So people wanted a consistent yardstick, a consistent measure with which they could price everything else. Now, if I take the current world, for example, if I'm pricing everything in apples and you're pricing everything in mangoes and someone else is pricing everything in whatever they're producing, it becomes confusing and it becomes hard to keep track of how much something is worth for everyone, given everyone has a different yardstick. But if there's a single yardstick, if there's a single measure of value across an economy, that would mean that everyone can just use that yardstick. So it became a unit of account. So it's easier for people to keep track of everything. So these were the three main purposes: the medium of exchange to solve the double coincidence of wants, the store of value to enable people to store their economic surplus and plan for the future, and the unit of account. Now, over time, people realized that some things just work better as money than others. For instance, the things that work better had a few properties that they shared. The first one of those was scarcity. And this is something we've mentioned before. You wanted money to be something that couldn't be arbitrarily created more of by any particular group or group of individuals or single individual, like by anyone. So to keep the system fair, to make sure that everyone would have to earn the money, to have to put in the effort to produce value for other people and earn money in exchange. So for that, money had to be something that was scarce. The other thing that scarcity did was it kept prices stable. So it ensured that prices did not run away. And this is something that I'm going to touch in later. Actually, and because this is a 30-day challenge, I don't get to cut out any mistakes I made. So I've made a few mistakes already. This is another mistake. There is already a video that I've made yesterday on the effect of a lack of scarcity of money and the terrible consequences it's having on us, on society. So you can go watch that video. Okay, now I'll continue. Scarcity is the first quality. The other quality that good money tends to have is durability, and this is linked to the store of value function. So the more durable a money is, the longer it can last, so the better it acts as a store of value into the future. You don't want your money to go bad, of course, right? The money that you saved by creating an economic surplus by working hard. So durability became an important quality, and of course, some things were more durable than others. Then came fungibility. Now, fungibility means that people should be willing to exchange their money for the money that other people hold. And this seems obvious today. Let's say you have a 100 rupee note and I have a 100 rupee note, we can just exchange, right? But back then, when let's say grains were money, there were some grains that were of better quality than others. So what people started to do is they kept the good stuff, the high quality stuff for consumption, and they used the bad quality stuff as money. And this was an unsustainable system, because eventually what would happen is you would just have the worse and worse quality of grains, of tobacco, of whatever it was that they used as money, that started circulating in the economy as money, and it got to a point where it was indistinguishable from dirt. So that system breaks down pretty quickly, and we'll get to this eventually, but you'll see why these properties meant that people moved from commodity money like grains and cattle to stones and precious gems to eventually metals, because stones and precious gems as well have low fungibility. Some look prettier than others, some are somehow more valuable or culturally relevant than others. But with metals that make standardized coins or some form of standardized unit that can be exchanged, the fungibility is very high. You would be okay exchanging 1 kilogram of silver that I hold in a bar form with 1 kilogram of silver that you would hold, or nickel or copper or gold, whatever it is. So metals solve for that problem as well. Fungibility is the third one. We've gone through scarcity, we've gone through durability, we've gone through fungibility. The final one, and this one is not so intuitive, is that good money, the better kind of money, tended to be otherwise quite useless. This is surprising, I know, but this makes perfect sense. Just think about it. Let's say you have a box of cookies. Imagine here is a box of cookies, and this box of cookies is money, and this is all the money there is. So let's say there's 10 cookies in this box. This box of cookies represents all value in the world. All transactions in the world have to be done with just this box of cookies. Now each gram of this cookie would be worth trillions, right? Because it has to capture, this box has to capture all transactions in the world. So as money, each gram is worth trillions, but it has a competing use case, which is food. It is useful in other ways as food. And as food, each gram of a box of cookies is worth a few rupees or a few cents. So the problem that comes with having money that can be used in other ways is that it has a competing pricing mechanism. It has a competing use case which causes the price to be pulled in different directions, and it makes it harder for that thing, for that commodity or that whatever it is that is being used as money. It becomes harder for that thing to be used in its other use case. So people would have to make a sacrifice then, that if they choose to use, let's say, copper as money, then copper would not be used as something else. Or if it is being used as something else, slowly it would have to be phased out and replaced with something else, because the price, the value of copper would go up a lot, because that whatever copper is available to that economy, that much copper would have to represent all transactions and all value in that economy. This is important to wrap your heads around, because this is the most counterintuitive of all the properties of good money. So good money tended to be scarce, it tended to be durable, it tended to be fungible, and it tended to be otherwise quite useless. And this journey, these four qualities explain the journey of money being commodities, to money being seashells and precious stones and gems, to money eventually becoming metals, and then within metals, why gold and then to an extent silver beat out competition from copper, from nickel, from other metals that were available, that were initially used as money. Because if you look at copper, if you look at nickel, if you look at some of the other metals, they are useful in other ways. They can be used as pots, as pans to begin with back in the days, but also as industrial metals. But you look at gold, it's very useless in so many ways. Even to make jewelry out of gold, you have to mix other stuff in, because it is too soft. So it couldn't be used industrially. It was very scarce, hence the total supply was kept in check, and hence there was no cheating on gold, and there was no price runaway on gold because of increase in sudden supply. And again, that video that I mentioned, that video will explain why the scarcity of money, the total supply of money, is so important, and what happens when that property is breached, what breaks in the economy, what breaks in society when that one single property of scarcity is breached. Gold was, of course, more durable than other forms of money, because gold doesn't rust. Copper rusts, nickel rusts, all other metals rust, even silver rusts, but gold doesn't rust. So gold was more durable, which also made gold more fungible. Because if I have a rusted copper coin and you have a fresh copper coin, I would be willing to exchange my coin for yours, but you wouldn't be so willing. But when something doesn't rust, it's the same, you can exchange. So gold beat out all other forms of money because it had these four qualities more than the other forms of money. Now, if gold was so good, if gold was so perfect, what was the reason that we moved from gold as money to paper money? And for this, you have to imagine an economy where everyone is using gold as money. Now, let's say you go to the market and you want to buy one apple. How do you pay for that apple with gold? Because you would have to shave off a tiny bit of gold to pay for that apple. Now, I am the one who's selling you the apple. How do I know that the tiny bit of gold that you shaved off is actually 24 karat gold? How do I know it's not mixed with other stuff? So there's problem with divisibility when it came to gold, breaking it down into smaller chunks. There were problems with verifiability, so purity checks, because the only way to truly check if any piece or any bar of gold is really pure is to completely melt it and recast it. That's the only way to check for sure that there's no other metal mixed in it. And of course, people cheated on this when they had the chance to, when gold was money. And people still do cheat on this when you buy gold jewelry or silver jewelry of any kind. When you go to these shops, you're getting cheated on some level. So gold had these two problems. The other problem that gold had was that of security. So when you carry gold around with you, firstly, it's a metal, it's heavy when you have big quantities of it, and it also tends to draw a lot of attention. If I have a 500 rupee note with me versus a 10 rupee note with me, it carries the same weight, it takes up the same space, so it doesn't bother you in any way. You wouldn't find out as a third person observer that I have a 500 versus a 10 rupee note in my wallet. But in the case of gold, the heaviness of gold, the physical heaviness of gold, made it obvious to people that someone was carrying a lot, and it was a security challenge. But more than anything, what happened is that the invention of telecommunication systems and the improvement of those meant that there were lines laid across countries, laid across even the Atlantic, where now from place A to place B that are really far away, that takes days, if not weeks, to cover physically, you had communication that would happen between these places instantaneously. So now information itself is traveling instantaneously, but gold, the settlement layer that happens between any two places or any two transacting parties, that is taking days, if not weeks, to travel, and that comes with a lot of security issues. So for the first three properties, so for the first three problems rather, the divisibility of gold, the verifiability of gold, and the security problem of gold, these three meant that banks came into existence. And initially these banks were private entities, they were not regulated by anyone, they worked on the basis of reputation. So what these banks did was they collected gold on your behalf, so they kept your gold in the vault, and in exchange for your gold they gave you these notes, these declarations, you can say, these promises that this person or this note means whoever holds this note can come and collect this much of gold from the bank. And let's say you deposited 100 grams of gold to the bank, they can issue 100 notes to you of 1 gram each or 1 gram worth each. So this is how paper money came into existence, that instead of transacting directly with gold, people started transacting in gold papers. Now, if you're the bank and you have everyone's gold and you're issuing papers against them, what you're supposed to do is collect the gold and issue only as much paper against the gold as much there is gold. So issue as much paper as there is gold. So if there's 1 kg of total gold you have to issue 1 kg worth of paper against that gold. But what these banks eventually figured out is that people, once they leave the money with the bank, once they leave the gold with the bank, not everyone comes to collect it back at the same time. So at any point of time, most of their gold is just sitting idly with them. And then they were tempted to make use of this. They realized that they could smartly make use of this. They could create new notes that were not actually backed by any fresh gold coming in, but they could just create these extra notes and they could issue these out to anyone who wanted money, who wanted to borrow money and promise to pay back more later. So let's say I'm a businessman and you're the bank. I come to you and I say, hey, I have this brilliant business idea. I believe it's going to make a lot of money. I need 1 kilogram in gold, and in 5 years I'm going to give you 1 kilogram plus 100 grams. Now the bank, what they started to do, they started to issue new notes, so an extra 1 kilogram of notes, gave it to this person, and this person would then go out, and if they were successful in the business venture, they would hand out the extra 100 grams along with the kilogram. So in this way, the amount of paper money exceeded the amount of gold. So the amount of claims on gold exceeded the amount of gold. And this is where people first moved away from the gold standard. And then when the communication lines were set and information started traveling instantaneously, They realized that even paper money, to transport it, it took basically as much time as it took to transport gold. So money went from gold to paper money, and then from paper money to ledger money. So money became a bookkeeping exercise, an account where I maintain a detailed ledger of all transactions that are happening with me, and everyone else, every bank else does the same thing, which is what still happens today. And then we double check, we cross verify to make sure that everything is aligning. So we went from gold to paper money to ledger money. Now, in this system, things are still, officially at least, backed with gold. All money is still backed with gold. But as the years progressed, more and more of this money, this ledger money or paper money, was created that was not actually backed with gold. Now, once again, I explain in detail what the consequences of that are in this video. But the point I'm trying to make is that gold was not technologically good enough, was not technologically advanced enough for 2-3 centuries ago, when information technology systems first came into existence. What makes you think that gold is going to be good enough for the 21st century, where economies are more and more digital, when transactions happen at a rapid pace, where transactions happen cross-border? Now, the arguments against this that people make are that you can have a gold-backed currency that would be tokenized in some form, either directly or on the blockchain or something else. The problem is that technically, even the paper money or the ledger money was tokenized. It was supposed to be redeemable for gold. But as the banks and eventually the government started printing more and more money compared to the amount of gold they had, there would be cases where there would be these run on the banks, where everyone, there would be panic, there would be some realization that would spread across an economy that, hey, the bank actually doesn't have as much gold as they claim, so we must go and we must get our gold back immediately, because this paper money is going to be worthless. So everyone would run to the bank and they would want their money back immediately. And when that would happen, because there were more claims on gold, there was more paper money than actual gold, the bank would run out of gold to issue. And this has happened multiple times in different forms over the course of history. And this has most spectacularly happened during the Great Depression, during the 1920s, 30s, that time in the US. So what happens whenever something like this happens is that the government or the banks, they de-link the paper money from gold. So they say that we are still backing paper money with gold, but you can't exchange gold for paper money anymore. And this is where the system starts to break apart. This is where what happens is that now they have an even freer hand in issuing more and more and more of paper money compared to the amount of gold that they have, because now they don't even have that external check of people coming in and being able to exchange their paper money for gold. And that is the challenge that any gold-backed currency will also face today, that it will have to be redeemable for gold. And that is the only way to ensure that the amount of money in supply is not exceeding the amount of gold. But it is so complicated, just on a logistical basis, on an operational basis, to have centers everywhere in the world where you can just walk in and have gold given to you in exchange. The amount of gold that has to be present in every center for the possible scenario of withdrawal. You never know when someone with a lot of money is going to walk into a small village with their money and wants gold in exchange. So there's always going to be issues. There's always going to be a temptation to print more, because what will happen invariably, what happens with banks, what happens all throughout history, is that not everyone will go and withdraw their money at the same time for many years. So there'll be a temptation to print more, and they will give in to the temptation, and then there will be a bank run. Then there will be a sudden realization, a cascade, so to speak, of realization that your money is actually being inflated away. There's not enough gold to back your money. And then when the bank run happens, the system falls apart and fails. We've been through this story multiple times. We don't need to go through this again to learn the same lesson. So gold was not technologically sufficient for the 17th, the 18th century. Gold is certainly not technologically sufficient for the 21st century. So whatever reports you hear of gold going to be the money of the future again, of gold replacing dollars, gold is very good at acting as a store of value over time. Gold is very good as acting as a neutral reserve asset, and this is important. I'll explain shortly why. But gold was not good enough for money, and it is definitely not good enough for money today. The neutral reserve asset thing. The reason why central banks have moved away from treasuries towards gold over the last decade and half, I would say, over the last 15 years roughly, but especially over the last 3-4 years, is the Russia Ukraine war. And I know this might not make sense immediately, but hear me out. What happened when Russia invaded Ukraine was that the West, especially the US, sanctioned Russia and froze any dollar assets that they have, including all the US treasuries that Russia held in their reserves. Of course, that pissed off Russia and that spooked them, but it spooked the rest of the world. So now every other country started thinking. So US was upset with Russia and they blocked all Russia's US reserves, US treasuries. What if they become upset with us for some reason in the future? If that happens, they're going to block all of our reserves as well. So do I want to hold US treasuries in a world where I know that all my money can be blocked away at any point in time? No, right? What you want to hold in such a world is a neutral asset, is an asset that is not controlled by anyone, that cannot be blocked by anyone, and that holds your purchasing power over time. And that's the second aspect. People realized that gold actually holds its value better than US treasuries, even though US treasuries give you a return on top of the dollar value that you hold. 4%, 5%, 2%, depending on the time you buy it, depending on the interest rates and the yield on the treasuries when you buy it. But it gives you a return on top, and still gold beats that comfortably over the medium to long run. So gold is not only a safer asset compared to the US treasury, because the US can sanction you at any point and freeze your holdings, but also the dollar based system could collapse. And after 2008, I told you, right, roughly 15 years ago, there was a shift that began. This happened roughly in 2011 when the shift started, when central banks started buying gold on a net amount, because before that, for many, many years, they were selling gold on a net amount. What happened in 2008 was the great financial crisis, and that sowed doubts in the minds of central banks around the world, and they wanted to diversify away from the US dollar. So that was step one. And step two, Russia Ukraine war and the sanctions, and now people want to diversify even more strongly. So gold is safer, gold cannot be sanctioned away, and gold holds its value better. So these three properties make gold a much better reserve asset than US treasuries. So this is the value of gold for countries, and this is also the value of gold for individuals to a great extent, that it holds its value and that it cannot be controlled in the same way that your typical bank account money can be. If you own physical gold yourself, if you own it in an ETF, then the control benefit you don't get, because an ETF can be controlled in the same way that your bank account money can be. Not in such a direct way, but it still can be controlled. You can still be blocked from using it, as opposed to physical gold, which is incredibly hard to trace and block. So to summarize, money came to solve three problems: medium of exchange, store of value, unit of account. Money had four properties that made it better: scarcity, durability, fungibility, uselessness. But also, even though gold fulfilled all of these properties and solved all of these problems, gold was not good enough to be money back then. Gold is not going to be good enough to be money today. Even if people ran an experiment, if countries ran an experiment and used gold as money, they're going to run into the same problem that they did before, which is more money than actual gold to back it with. It's incredibly hard. It's basically impossible to stop the tendency of institutions to print more money. This is what I want you to walk away with. Just realize that gold is not good enough to be money today, even though it might be a good investment, it might be a good asset to hold. There is something that is good enough to be money today that has all the properties that we talked about, but better, and it solves for any problem that gold has or had back in the day and still has today, which is Bitcoin. Bitcoin is scarce. Bitcoin is durable. It is infinitely durable. Bitcoin is infinitely fungible. Bitcoin is otherwise more useless than anything else on the planet. And Bitcoin is already valuable. It's something that value. It can act as a medium of exchange. You can settle instantaneously anywhere in the world. You're in India, you have a friend in the US, you want to send them some money. Today, you try to do that through the traditional rails, to the traditional mechanism through which money moves, like the SWIFT mechanism, and it takes 2 to 3 days, 2 to 3 working days. So if you have a weekend in between, it can be 4 to 5 days. Bitcoin settles in roughly 10 minutes. You need maybe 30 to 40 minutes for 3-4 blocks to pass by, so you have enough of a confirmation. The cost of transaction is much lower. It is independent of the value, firstly, which is a good thing if you want to transfer big amounts, but it's also a very low amount. Currently, for transferring any amount in Bitcoin, so any value ranging from a few rupees to a few crores or 100 crores or 1000 crores, you will have to pay roughly 15 rupees in transaction fees. That's it. That's how cheap it is to transact with Bitcoin, and it would take at most 30 minutes to get your transaction confirmed. Bitcoin, a lot of people criticize that cannot be used for smaller transactions, but that's not true. You have layer 2 solutions like Lightning, where you can go into a coffee shop and buy coffee with your Bitcoin. This is the colloquial example that people use, that how can you buy coffee with Bitcoin? You can use the Lightning network. So Bitcoin has solved for all these problems, and I'm going to be making more videos on this. So tomorrow's video is going to be an in-depth review of how Bitcoin solves all the challenges we've discussed yesterday, first with the increase in money supply, and today the problems with gold. I'll tell you tomorrow how Bitcoin solves for these problems. All right. Thanks for watching. Leave a comment down below if you have any questions, if there's anything that doesn't make sense, if there's anything you want me to cover, and I'll do that. I'll see you tomorrow. Bye-bye.